Hi everybody, Frank Finance here. Today we're going to be doing a stock analysis on EPR Properties, which is a real estate investment trust or REIT, and the ticker symbol for this is EPR. For today's agenda, I'm going to give a price target. We're going to look at 2021 Q1 results. I'm going to give a brief business description. We're going to look at the stock price history. We're going to look at the performance versus its peers, and also we're going to look at the fundamentals and the financials. I'm going to talk about some of the dividend information they discussed on the last earnings call, and then I'm going to give my final thoughts on EPR as an investment. As a reminder, hit that like button anytime throughout the video. It helps me out a lot with the algorithm. If you're new to my channel, I do videos on stock analysis, personal finance, and investing. So if you like this type of content, please consider subscribing. Now to the content. So getting right into it, my price target for EPR Properties is anywhere from $65 to $70 in the next 12 months. That indicates a 21% to 30% upside for EPR Properties. So stick around, watch the rest of this video, and understand why that price target is where it is. EPR Properties first quarter 2021 results were released on May 5th, so about 5 weeks ago at this point. The results came in, funds from operations were at 48 cents per share. That estimate was at 34 cents, so they beat by 14 cents per share, or about a 41% on FFO. On the revenue side, that came in at $111 million. On the analyst side, they estimated $100.7 million, or beat by about $11.07 million. That's about a 10.9% beat on revenue. So did really well there. A 41% beat on funds from operations and a 10% beat on revenue. So check both good green check marks there for EPR. So jumping into the press release for the Q1 2021 results, there's 2 bullet points I wanted to cover here that I thought were important. This quarterly collections continues to increase. So in April, which is the first month of Q2, they had a collection rate of 77% compared to the Q1 collection rate of 72%. So good 5% increase there. Hopefully that trend continues with May as well as June, and we see that in our Q2 results. We're going to look at something needing to be, collection rate definitely needs to be above 72% for full Q2. Strong increase in theater reopenings expected. Approximately 71% of the theaters were open as of April 30th, which is the first month of Q2. And by the end of the second month, May of Q2, they're expecting that 98% of those properties should be open. So I'm hoping, and I believe EPR hoping that with those reopenings, they're going to get back to a higher collection rate here. And so that's something that we're going to really want to pay attention to, as future quarters go on. Once this reopening happens and movies start to come back, these collection rates should continue to get higher and higher and higher, as theaters are a large percentage of what EPR's portfolio is comprised of. All right, so as of Q1, the top 10 customers by percentage of total revenue for EPR was AMC Theaters, which is a huge buzzword right now in terms of their stock, but they are making up 21% of the revenue. Topgolf at 18%, Cinemark at 9.5%. Vail Resorts at 6.2%, Camelback at 4.7%, Six Flags, Endeavor, Empire Resorts, Creme de la Creme, and Andretti Indoor Karting, all making up about 73% of their total revenue for Q1. So really big thing here. All that's telling me is, look, this AMC thing of having AMC not going bankrupt is going to be very impactful and a good benefit to EPR moving forward. If we move into other updates, we mentioned on this earlier that they do anticipate the amount of theaters opening to grow into May, which has already occurred. April's box office, they also anticipate that to increase substantially over the March, and that's expected with the vaccine rollout. On the non-theater properties, 96% of those non-theater properties are open, and so that's good news. So EPR Properties is a real estate investment trust, and they really specialize in a very specific type of property. That being really what they define as experiential real estate. So if you kind of look on this nine little tiles here, you have theaters, gaming, attractions, eat and play, ski, cultural, fitness, live venues, and experiential lodging. Just kind of break that down a little bit further. They kind of break that into theaters, at least their portfolio mix of those tiles is 46% of their contractual revenue comes from theaters, eat and play, which are those, let's see, eat and play would be the golf facilities, the family entertainment centers, the bowling, karting. Those are, they make up 26%, ski resorts 8%, attractions 7%. You can see the rest there, but in total, the experiential properties make up about 95% of their contractual rent or the revenue, and the education side of it makes up about 5%. Hey, you're still watching. Please consider liking the video. It helps me out a ton. Make sure you smash that thumbs up button. Thanks so much for watching. Now back to the content. So we saw that EPR Properties portfolio is highly concentrated in theaters. So the question really comes up, will streaming kill the movies business? And so EPR Properties provides a slide that I want to share regard to that mix of what people are watching on streaming. So in 2020, all of 2020, 85% of what was streamed came from series. 53% of that acquired series, 32% original series, and only 15% of the total watch time was movies. So that's, I think, a good thing for the business. I don't have any historical on if the movies have been growing over the years, but it does seem positive that it's a very small segment of the streaming watch time. Another slide that they provide is the annual U.S. box office revenue in billions over time. So since 2005 to 2019, they provide a graph, and then they also provide when that streaming service came online. So Netflix came online around 2007, Hulu in 2008, Prime Video in 2016, Disney Plus in 2019. And you can see over those 14 years, you can see that there is a slight trend in the positive. While it isn't huge increase in total, it isn't a declining business, or there's no data here to support that it is declining. So I think these are two good things that support EPR's current portfolio concentration. As it might not be a growing industry, they might not be making more money in that specific 46% of their contractual revenues coming from it. But it's also not going to be somewhere where they have to be super concerned about revenues dropping in movie or theatrical revenues dropping. Therefore, they may have an issue with revenue moving into the future. Really, their biggest headwind is going to be the recovery from the pandemic and the theaters coming back online, as well as the movies themselves coming back online. All right, so looking at the stock price history over the last 5 years, you can see that EPR started trading around $70-something a share, and before the pandemic started, they're still in that $70 range. They quickly dropped down to about $18 per share. They shot up to a little over 40, went back down to sub 30s, and I actually entered in the position on the 14th of December 2020. And since then, now they're up at about $53.73, and I still think they're poised to get back to where they were pre-pandemic. Looking at kind of expanding that out over their history, EPR has been around for a while. They've been able to go, weather 2000, weather 2009, get through 2016 and 2018 pullbacks, and I believe also they'll be able to weather this one as well. And I still think they have that 20 to 30% upside, just looking at their chart here. So let's move on to price performance versus the industry. If we look at EPR in comparison to some other REITs, Specifically, I want to look at SRG. SRG is a little bit different. They're more retail oriented, but they are definitely more specialized than O and VNQ. VNQ is an index. O is real estate investment, another REIT, but they realty income, and they do triple net leases on like Walgreens and CVS's and other things like that. So while their customer client base is definitely different, I just kind of threw out some different types to see where they fall in terms of how this REIT is comparing to some others. So SRG is definitely the weakest performer in terms of since the pandemic. So I have this chart since February 1st of 2020 to 2021, or till today's date of the 14th of June. And you can see that VNQ's up 11.5%, O is at negative 10%, and EPR is still 25% down from their pre-COVID lows or pre-COVID high, and SRG is still down 49%. So pretty variable here. Not a lot to ascertain from this, but it does kind of give you a feel for where APR is and kind of the landscape of recovery back to where they were pre-pandemic. All right, so jumping into EPR Properties financials, we look at their 2020 results. They were down 37% from year over year. That's down from 650 million to 408 million. So a pretty big decline. If we look at how they've done over the last several years, they've definitely been growing 15%, 6%, 7%, 10%, 15%. So they're doing fairly well up until the pandemic, and since most of their, nearly half of their business is in theaters, they saw a fairly large drop in revenue on that side of the business, and it reflected in their performance definitely. So if we look in their last quarter, I just want to see some improvement in their numbers. You saw the biggest decline in the September numbers here, and you can see that it was on a downtrend, and then now it looks to appear to be on an uptrend. The good news is this 26% is lower than this revenue growth for the total of last year. So I'm hoping what we're seeing is a decrease in how much a decrease in revenue growth. I don't think we're going to see an increase in revenue growth from 2020 to 2019 to 2021. But I do think we'll see something better from 2020 to 2021 fiscal year for EPR, which again at least gets them back to where they were pre-pandemic, which should at least give some lift this stock a little bit more than where it is currently. Once again, I have to ask you, please hit that thumbs up button. It helps me out a ton. Thanks so much for watching this far. Enjoy the rest of the video. All right, if we jump over to the balance sheet, we can see that total cash and short-term investments is at $538 million. We scroll down to short-term or current liabilities. That's at $82 million. So they have more than enough cash to cover their current liabilities. That's great. Total assets at 6.2 billion. A large majority of that, please keep in mind that that's property. So 6.2 billion in assets, $3.5 billion in liabilities. Huge check mark there, in my opinion. Moving on to cash flow. So cash from operations in March was 78. They're not reporting any capital expenditures, so I'm not going to be able to do a free cash flow here on this one. All right, so looking at revenue estimates for 2021, they're estimating $462.87 million. That's 3 analysts for all of 2021. If we look at the 2020 earnings, is at 408. So if we look at their last quarter at $110 million that they made, multiply that by 440. So they're expecting some revenue growth in between Q2, Q3, and Q4. to get up to that $460 million. Keep in mind that 2016 was at 650, 2019 was at 650, 2018 was at 564. And if we look at 2022 numbers, they're looking at $539 million for all of 2022, which is still below the 2018 number and the 2019 number. So again, they're still not estimating a full recovery, even in a year and a half from now. So please keep that in mind. We'll need to pay attention in future quarters, see if these estimates get adjusted. My feeling is that they get, these estimates get raised here in the future quarters. So the last thing I want to look at is shares outstanding. If we look between 2017 and 2021, we can see that shares outstanding definitely increased between 2017 and 2018. But since then, we've had fairly stable, and even the increase here wasn't huge. I mean, it was, 10%, which is, I would say, a little over 10%, which is pretty high. But between 2018 and 2020, it only increased about 4 million shares. Less than, a couple percentage points. I'm not too worried about that. And honestly, it seems like they've gotten back down to where they were, at the start of the pandemic. So I'm not too worried about this here. It looks appropriate. No dilution here that I can see in the last several years, or very minor dilution at that. So looks good on shares outstanding. All right, so moving on into dividend news. EPR cut their dividend sometime around May of 2020. Prior to the cut, they're distributing monthly 38.2 cents a month, or that annualized is $4.54 a year. If you turn that into a dividend yield based off of today's price, that's about 8.5% yield. Again, they're not distributing a dividend right now, but in the latest earnings, they also released some guidance on how they expect to get back to reinstating a dividend. So the first step was to improve and stabilize their cash collections, exit existing debt covenant waivers. So those debt covenant waivers are really controlling whether or not they can actually distribute dividends. So there's actual clauses, those covenants that they refer to, prevent them from legally distributing a dividend until those debt covenants are paid. So once they can do that, they can consider reissuing a monthly dividend. They do have some dividends they issue that are not common dividends, but I'll talk about that a little bit later. After that, they'll reinitiate investment sending. So the priority is cover those debt covenants, reissue the common dividend, and then reinitiate the investment spending. Now, their guidance is they should be able to do that during the second half of 2021. So what that means to me is during Q2, they're hoping to see some positive changes that will allow them to reinitiate the dividend or pay off the debt covenant, and see some traction in the third quarter and the fourth quarter of 2021. So that's really good. We could see that dividend being reinstated, either to its former price or something, at least something by the end of the year. If we look at what they had in their press release, I'm just going to read this. Monthly cash dividend to common shareholders was suspended following the common share dividend paid on May 15th. The company is restricted from paying dividends on its common shares during the previously disclosed covenant relief period under certain of its debt agreements. This is basically what I'm saying is they have to cover those debt agreements before they can start issuing another common dividend. So. And then the second paragraph just says that there are some dividends that they are issuing to preferred shareholders, and they're obligated to pay those, but to common they can't. So we're hoping that they can get those things done by the third and fourth quarter. Definitely more on that as they get into future earnings calls. So for my thoughts on EPR, I think EPR has done a fairly good job from a management perspective weathering through the pandemic, especially as theaters make up a large majority of their contractual rents. That large portfolio concentration in theaters definitely took a big hit in 2020, and it'll take some time for theaters to recover. But as we discussed earlier, I believe there is going to be continued demand in theaters. It's just going to take some time to get back to where they were. If we look at AMC in particular, what's happening in their stock and the reissuing, while it's bad for AMC stockholders, this is a great thing for people that have rent from that AMC is due. So since AMC is a large customer of EPR, them not basically having bankruptcy taken off the table is an amazing gift to EPR's shareholders. It almost guarantees at this point that AMC is not going to go bankrupt. They're continuing to issue shares, AMC that is, at crazy prices, and that's good. AMC needs the money so they can pay their debt, which in some of this case happens to be EPR, as they have a lot of property that they control that AMC pays rent on. Now, moving on from that, they themselves, EPR, has not been issuing shares through the pandemic. Relatively, they're basically where they were pre-pandemic. So that's great. Don't like seeing issuing of shares for the companies that I own, especially ones that aren't really growing super much like EPR. And it's going to take them some time to get back to their previous revenue. So we don't want to see new shares being issued here. Their debt has been under control. We reviewed that. They haven't been increasing their debt substantially to get through the year. And they've been able to reduce their investments to offset the income loss. So what that basically means is you can think of capital expenditures. They basically were not spending as much on some of those things so they could not have a loss in the current year. Now, moving forward, as income comes back, they're going to start reinvesting into that so they can start buying new properties and continue to grow the business. So I think you'll see some stagnation in growth just because they can't pump that money back into the business because they're not generating it. So you really have to, that is definitely something to consider as an investor. As I said earlier, I still believe that EPR can get back to the $65, $70 range in the next 12 months. If they do, I plan on personally selling EPR. This is not a long-term strategy for me. I do believe they had strong upside when I bought them back in December, and I still believe that they have that today. And that upside from right now is about 21 to 30%. So good luck with your investing out there. For this one particularly, the action that's happening in AMC is actually beneficial to me. So keep it up. If you like this video, please consider subscribing, hit that like button. Thanks so much for watching. Frank Finance, out.